How are we looking? Is this live? All right. Welcome to this happy hour edition of Trading Homework. Today is February 19th, 2021. And we'll be enjoying this Mind Haze IPA while we go through some stock market research. So yesterday, we were going through a list of ETFs, and I've got that list here on the right side of the screen. And so you guys can copy that, or pause the frame if you need to and screenshot that list or whatever. Yesterday I showed how you can make your own similar list by filtering FinViz. You can go into the I think it's industry and then pick ETF, and that'll filter out all the stocks, and you'll just be looking at ETFs. And then I go through that list and grab all the names that are I sort by volume, and then grab the names that are not leveraged or inverse ETFs. So I don't want to start all the way at the top and work down through the bottom, because we went through the top half of this list yesterday, and really we're just trying to have an informed macro view right now by going through this list. So I think my plan is to start with the energy stuff, which is where we left yesterday. All right, so let's dive in. So we left off yesterday. We were looking at some energy stuff, and so this is kind of significant to me that we broke above this 45 level, and I mean this was big in June when these energy stocks kind of petered out and ran out of gas, pun intended. It looked like lights out for this sector, but it kind of held up. It didn't go down and make a new low late last year, to my surprise. And now what we've got is kind of this big cup and handle shape. This is not really a cup and handle, but when you see a sector ETF that is shaped like this, then you can expect to find stocks in that sector that do have cup and handle shapes on them. So this is probably going to be an interesting place to look if these stocks are breaking out right now. The sector itself doesn't really have a good volume pattern for breakouts. Some of the big news in the sector was Chevron. Warren Buffett came in and made a big acquisition here. So that's something that's going on here. We can look at oil price too. But before we jump to oil price, let's look at, let's look at oil price. I'm going to look at the USO ETF, and let's look at WTIC. And these are weekly charts we're looking at. Sorry if the color is a little washed out. I actually delayed starting the stream because I was trying to figure out why the color was washed out. And it looks like I'm going to have to do a little bit more work to get that solved. So the kind of cup and handle shape, we see it already happened on oil itself, and oil is just riding the upper Bollinger Band higher. There's a lot of things riding their upper Bollinger Band higher that we saw last night, and you can go back and look at that in the replay. If you get to the end of this broadcast and you want to cover some of these that you see higher up in the list. So going through this review yesterday, one of the themes jumped out was jets, and so today I did go in. Now let's actually rewind and look at jets for just a moment. Oops, not $ jets, just jets. And this looks like a really clear breakout from a handle here. I went into the Jets ETF, and I found that the largest holding in there was ticker symbol LOVE, L-U-V. This is Southwest Airlines. And so what I did is I put on some out of the money, almost elite position. I got it for January of 2022. And I got it at a much higher price. The Leap. I think I got a few of them, but the point is to nibble. I was just establishing an initial position today, and if it goes down, like on down days, my plan is to add. And if I sour on this sector or this theme, then I'll just dump that entire position and take the time value that's left and use it to go do something else. So we went through a lot of the marijuana stocks yesterday, comparing them to the sector. What we didn't do was dive into JETS in the same way and look at some of the holdings in the JETS ETF and compare them to the sector. So you can see here, Southwest Airlines is the largest ETF. Or I'm sorry, it's the largest holding in that ETF, and so its movement kind of resembles the ETF. The options market for Southwest Airlines is probably a lot more liquid than it is for the JETS ETF. That's not true for everything, but in this case, I think that's probably true. So if we just look at JETS, we see at a $25 share price, we see a volume of 6.5 million. Let's look at Southwest. It's twice as high of a share price, but the same volume today. And so you can expect better liquidity here. Now, it may be that the options market is more mature in JETS than in Southwest Airlines, but I don't think that's the case. So if it was, then I would trade in the ETF. So sort of like how a couple days ago I talked about the uranium ETF was not liquid, but one of the large holdings in it, Cameco, CCJ ticker symbol, it is more liquid. And so I end up doing some trades in Cameco and not in the uranium ETF. So similar thing here. All right, let's move on to, I'm going to look at UGA, which is a gasoline ETF. And this thing, I don't know. Oh, it's because I have it on a daily. Let's look at weekly. Okay, so the price of gasoline, according to this ETF, it has a small fee that makes it kind of erode slowly. Or, it'll have a slow decay on it, but it's not that much. So it does tend to rise and fall with the gas price. And you can see this, again, the same theme, just riding this upper Bollinger Band higher. If it gets ahead of it, then it pauses and then starts moving again. However, gas is now kind of back to where it was, according to this ETF, before COVID, before the lockdown crash in 2020. Something interesting I'll note about UGA while we're in here is I like to look at it as a ratio chart with USO. And you can see that it does tend to outperform, although that effect will probably be smaller because going forward, the oil ETF, the USO, their roll schedule is less aggressive than it used to be. And that was in response to the oil price going negative. They decided that, well, in order to keep this fund alive, we should push out the calendar, our roll schedule a little bit. So it's probably not likely, USO is not likely to have quite as much time decay now as it did in the past. So one thing I'll point out is it's more expensive to store oil than it is gas, I think. Maybe I'm wrong about that. But I could be wrong about that. But I know that gas has to be, there's a refining process, and that can only happen in a refinery. There's only so many of those, and they're situationally located. So there are some macro aspects to gasoline versus oil that can make for interesting trades. And so we saw that play out during the lockdown crash of 2020. We saw kind of an interesting phenomenon there. Let's keep moving. So next up is XOP. And this is the Spider Oil and Gas Exploration and Production ETF. You might find that you get more juice from this than you do from XLE. These tend to be smaller companies, I think. So let's do an XOP colon XLE ratio. And you can see that it was trending lower and now it's trending higher. So I would suggest that this is a positive tailwind on energy trades. When these are outperforming the exploration companies, it's probably a good sign for all of the oil-based energy space. The reason I would say that it's similar to the miners. If there's not a lot of demand for the product, then what happens is they've already explored and found a lot of the minerals underground, and when the price goes down, then they can't afford to go and get what they've already found. But when the price goes up and they can afford to go and get those harder to reach mineral deposits, then that's when the need for exploration comes in, and it can become viable to seek out new mineral deposits. So just from a macro theme, it makes sense. All right, moving on. We did look at a couple of these yesterday. So AMLP is just something I also like to look at. Interesting. I mean, it's not made a full recovery yet, but it sure did take its time. And it's just kind of back up to the level where it was in June. So a lot of people who were following me on Twitter, it's at Jon Tait, JONTAIT on Twitter. Those people who were following me back then know that I was going in like crazy buying these MLPs in March near this low because the interest rates on them got so high. And so that was really the big tell. If you look at the interest rates on this stuff right now, it's a lot less attractive. And not only that, but there's been big dividend cuts. So it's an interesting thing to watch, and you could go in and maybe pick the ones that you think have the best prospects if you want to be a dividend investor in this space. And that's a fun thing to do. It's not really my specialty. I was putting a lot of focus on this and the mortgage REITs at that time a year ago, but I'm pretty dynamic. I don't just stick to one flavor, and that trade for me kind of played out by June. I was pretty much out of all that stuff, and really I got lucky because to sit out the rest of this where it hasn't really gone anywhere. This is a dividend adjusted chart, so even factoring in for the dividends, that money was just been sitting there dead in the water. So that's a reason why it's important to have a lot of different dimensions to your investing research and your trading research, and however it is that you like to make money. All right, next up, we're going to look at XLU. This one's kind of interesting right now because of the power outages in Texas. I would have thought that this would have been going higher, but maybe it's going lower because of the increased price in natural gas and some things like that they may not be able to pass through to the customers. Could be why this is lower, because the power, there's been power outages all over the country, and really a lot concentrated in Texas over the last week with the snowstorm. I don't really have a whole lot to say about it other than it looked like kind of a chart that was firming up to look good. It looks like it's kind of falling apart. So utility stocks are notoriously slow moving. All right, XLI. Industrial. I mean, this is pretty strong. I'm not sure what holdings are in this. We could go look. It's probably worth a look. But I was looking at copper today. Freeport-McMoRan, FCX came up on the most actives list. And I mean, it's just crazy strong. It kind of looks like this, where it's even more of a straight line up. And I'm going to suggest that as long as copper is strong, that's a tailwind for if you want to call this a bull market that we're in. We're going to talk about rates soon tonight, and I mean that looks like a fuse lit, and so as long as you can guess how much time is left on the fuse, and copper is still running up, then maybe you're good to just keep holding and pressing your luck with stocks. A lot of professionals are looking at the markets right now and kind of second guessing the wisdom of just holding on to stock holdings or doubling down, betting on leverage, carrying big positions. There's a lot of old hands that I'm reading on Twitter that they're skeptical, or they're starting to trade on the short side, or they're putting on hedges. I'm putting on hedges, and I've got most positions I have, certainly not all of them, but I have a lot of positions hedged directly, and then indirectly I'm kind of jumping ahead here, but indirectly I'm hedging with HYG puts. So we can talk about that a little later, but let's go back to XLI for a second. I did want to dig into the holdings of this ETF. So give me a second. I'll get a window open and we'll dig into that. XLI. All right. So hopefully that's coming up on the screen for everyone. I know this browser window looks kind of washed out, so I'm sorry about that. I'll try and get that dealt with soon. And I sometimes I have an echo on the microphone too, and sometimes I don't, so I'm trying to figure that out too. It's a new show, so sorry. All right, here's the holdings. Honeywell, Union Pacific, UPS, Boeing, 3M, Raytheon, Caterpillar, General Electric, Deere, Lockheed Martin. So we see some military contractors in there alongside some, like 3M is, I think, in Kathy Wood's 3D printing ETF also. So it's kind of an interesting overlap. Let's double check that before I go on record here. I don't want to mislead people. The 3D printing ETF holdings. Oh no, it's Square D, or no, this is not Square D. 3D Systems Corp. So this is not 3M. It's DDD. I thought that was MMM. Okay, so I got confused there. That makes more sense. So Caterpillar and John Deere, these are really interesting holdings, and there's a theme there. So there's a few different themes in this. Union Pacific, that's a different theme too. This is a really interesting ETF. I don't know that I like the idea of getting invested into defense contractors. And one reason for that is because I don't really want to put myself into the cheering section for, the kind of stuff that is their business model. So if I were going to take any action on XLI, probably I would go in there and cherry pick names from it. Let's see if we can figure out which is attributed, which ones are contributing to this strength the most. And then I want to circle back to Jets also, because when I looked through that, I did find a company that was standing out that was like a travel agency. I try not to be all over the place though, so let's just quickly go through these. I guess I'll start with Honeywell. Yeah, it's up a lot, but that's not a crazy chart. UNP could be doing really well right now because of the pipeline news. I don't know if that pipeline getting canceled or paused or whatever, I think that may help the railroads, but it doesn't seem to be doing much for this chart. UPS. I gotta imagine that if ever UPS had a great macro backdrop, it was 2020, and it already did run up pretty big back then. So that's neat. It's very near. I don't know if these are all-time highs, but it's very near the highs. That's just looking really, really strong. So UPS, wow. And up here, it's not selling off. It's hanging out at these new high prices and basing. It looks like it's, it could get interesting if it comes up here, tests this old high around 176, and then makes a handle. And then maybe we'll get a breakout to new highs. So that could be interesting to watch. Not really my bread and butter, but nevertheless, it's an interesting chart. This would be a good one to watch. Boeing. I know that Boeing sold off real hard last year, and it's kind of making a recovery. It does look like the jets theme. I don't think Boeing is in jets though. I didn't see it in the top holdings. Let's flip over to that in this window. Jets. All right. Holdings. Yeah, no Boeing. I'm not sure why it's not in here. Maybe because it's really like airlines. But there, I did find an exception. This Allegiant Travel, and this is the one I wanted to show. ALGT. I wanted to show this chart because I put in most of those airlines into a ratio chart against jets. And when I put in this travel agency, I mean, this looks great. This is like, pair traders look for this kind of stuff. So what you can do is you can find like some of the weaker airlines and you can short them and you could go long this ALGT, the travel agency. And you're kind of protected because if that sector gets hammered or the ETF sells off, that, if ALGT sells off, then probably the jets are going to sell off too. So charts like this are really interesting to me. Let's look at it just by itself. ALGT. Pretty strong. I mean, this is, I'm shocked actually about how far this has rebounded. And I think a lot of people that were in there buying like Carnival and jets, that this is what they were thinking would happen for that entire sector. And I mean, I'll be honest, I didn't think that lockdown would last as long as it did. I didn't realize that it would become such a political thing. But, I mean, we all heard this stuff like, oh, just 2 weeks to stop the spread. Well, I mean, that was a bait and switch. So I'm surprised at this rebound. I'm not sure what's driving it. If I was going to chase this, and let's face it, if you're buying this thing at highs like this, it's chasing it. If I was going to chase it, I would need to dig in and find out, what is the drivers for this price move. And it could just be a short squeeze, although I don't think that's the case. We can go into ALGT and take a look at the statistics on here and see what's going on there. So float 12 million, short percent of float 4.4%, so pretty low. So that's not really probably a driver. All right, what's next? XLF. Okay, somebody that I follow pretty closely on Twitter is Flyer user, or it's here. I mean, I can just show his Twitter. Hang on. He's been talking a lot about banks, so let's get this bank ETF up and let's dive into banks and rates. So this is super important. Hang on. Flyer user. There we go. All right, here we go. Okay. So if you are interested in banks and interest rates and trading that theme, this is a really good follow right here. So we share trading ideas a lot. So we were both on this Cameco thing for a while. So BKU. Anyway, I'll let you guys look into it. You can follow up there. This is a great follow. So his idea, I think, right now, his theme is that with rates, with the yield curve blowing out at the long end the way that it is, that's good for banks because they can borrow short and lend long. That's their business model. So when the yield curve is wide, then it's very good for the bottom line at banks. And so he said, take a look at BKU, Bank United. Yeah, so they're all kind of running in a similar way. And the yield curve being steep like it is, that's a driver for bank profits. However, I talked about rising rates right now being kind of a fuse being lit. And so let's get into that for a moment because I've got those a little further down here, so probably I can group this a little bit better. But we'll just skip over them when we get to them later. So what looks like is happening to me is TLT is just going down, down, down. And when I zoomed out to the monthly, it's a lot clearer picture. Let me zoom way out on this thing. Hang on. Okay, so now we can see that it does tend to have a gravity on this purple line here, which is a 50-day, it's a 50-month moving average. And so with the lockdown crash last year, it got so far ahead of itself that now it's kind of reverting back down to this 50-month moving average. And I don't know that it's going to go below it. It doesn't stay below it for long. But, this is probably a target for people who are shorting this thing. I'm not shorting it. But once it gets down there, it can hang out for a long time. Like, it can go, TLT can go sideways for years. We see it all the time. But, I think that is going to act as a strong support level. And that's a lot lower too. Dropping from 143 to 130. That's a big drop for something like this. I don't know if it's going to happen all at once, but now let's talk about, so when I talk about a fuse, here's the fuse. So all these bond funds or the different classes of bonds, they're all kind of competing for the same investment allocation. And so when rates go up in one place, it becomes more attractive for new investment. So I'm not saying that people are rotating their bonds or that they're selling bonds they already have, but when the coupons come in or they have new money to invest, they're going to try and look to put it in an attractive place. And so they're going to compare, municipal bonds, government bonds, and mortgages. There's a whole bunch of different choices that they can make. Another one is corporates. So we see TLT going down. It's fallen substantially. And it's probably going to keep falling, as we saw earlier, lower. As it goes lower, the yield on it goes higher. And so what it does is it starts to pull money away from other places that were getting investment dollars, like investment grade corporate bonds. So now we see that LQD is falling, and it's been falling all year. TLT, I think, has been falling longer than that. Yeah, TLT's been falling since, I think this is July or August of 2020. So it's been a downtrend for a long time. The longer it's in a downtrend, the further down it goes, the more investment dollars that it's going to attract away from alternatives that have like a higher risk for investors. So LQD is now starting to get hit from this. You can go in and you can look at the interest rates on these things. In fact, probably we should do that. So let's start with TLT. Let's see what it is now. Yield 1.5. So this is based on the dividends. It's Yahoo's calculation. We can hope that they're going to at least be calculating these things similarly across the different ETFs. So Yeah, and it's down a bunch this year. So 1.5%. Well, with the price being lower, that yield has gone up. So now let's look at LQD. So you're only getting about a 1%, 1.16% higher yield by going into corporate bonds. But the government is not going to default on you, but some of these corporate bonds might. These are investment grade. Well, the risk is, what if they get downgraded? Then it's not so much a default risk right now as it is a downgrade risk for the bonds that are in LQD. So the point is, if money goes to treasuries instead, then it actually pushes these rates up, which makes it more expensive for these investment grade companies to borrow. And so when I talk about a fuse, think about dominoes. So the first domino we looked at was TLT. Then we looked at investment grade corporate bonds. Now we're going to look at high yield corporate bonds, which are junk bonds. So HYG, look at that. It hasn't been hit yet. So, these are dominoes falling over, and this one hasn't been hit yet. So the way that I'm hedging portfolio risk right now is by buying HYG puts, because it hasn't been hit yet. It's so cheap. If TLT keeps going down, let's look at the yield on HYG. Less than 5%. So, that's pretty low for junk bonds. And again, all this stuff is relative. These are relative investments, because they're alternatives to each other. Like if you're allocating capital, well, why would you allocate capital to junk bonds at 4.9% when you could put it somewhere safer? You could put it in the investment grade bonds at 2.6%. You're not making that much more to go into the junk. But the risk you're taking is so much higher. So we're in a phase right now where people they kind of have their eyes closed to the risk that are in this. It's either they bought it at higher yields and haven't rotated out yet, or they're buying it and just closing their eyes and hoping for the best. This is like a notoriously dangerous thing to do with junk bonds, because these also have the downgrade risk, and they have default risk too. Much higher default risk in corporate bond or in high yield corporate bonds than in investment grade corporate bonds. That's generally the case. It may not always be the case. Like if there are companies that currently are just barely hanging on to their credit rating, and they're in the investment grade category, then maybe the downgrade risk is higher with them. But ultimately, the amount of money you could lose in high yield bonds is generally higher. So when we look at this, let's look at these sell-offs. Okay, so as money was coming out of high yield bonds, this is a pretty steep sell-off. It looks like 20 to 25%, something like that, just in about a little over a month. We'll say 6 weeks during the lockdown crash. Compare that to LQD. So LQD lost, it lost a lot too, but it rebounded really fast. It rebounded much faster than HYG. So I think for someone who bought them in the beginning of the year, they had their money back pretty quickly, whereas with HYG, not so much the case. They had to wait longer to get their money back. So on a percentage basis, here, let me just run the calculation. So HYG 64.48 divided by 84.13 minus 1. So that was a 23% drop from this peak here to this low. The one in LQD, I'm surprised at how steep that one is. And I remember at the time there were some people who were looking at the holdings of LQD, and they were calling out that it was vulnerable to this kind of a correction. So let me run the math on this one. 102.42 divided by 131.29 -1, so 22% drop. So just about the same magnitude. That's just because that's what happened in the past doesn't mean you can expect that in the future. But it might be a good place to also buy puts. So get puts on LQD and HYG. I haven't done that. I've just been in HYG so far. If you want to see how cheap those puts are, let's go take a look. Yeah, I already have the tab open. So I'll show the trade that I have on. It's I'm calling this a rainbow combo because I'm essentially like buying an at the money put and then buying further and further out puts. And so what happens is I'm getting this one for really cheap, the one that's furthest out. So it doesn't cost me that much. But if there's a big down move, it really kicks in. Ultimately, it's not necessarily going to make that much more. It's just that I get it for so much cheaper up front to the at the money one. And so when you look at that combo, so the reason I call it a rainbow combo is if you look at it, it kind of looks like it bends like a rainbow. So it hooks higher and higher because, you know, we've got this sort of stripe across all these strikes. So this looks like really cheap protection to me. I featured this already. I've already spoken about this on another trading homework from maybe like a week ago. And I do already have some of these on. So it might be better. I might have been better looking at the liquidity. So it looks like this 83 doesn't have a whole lot of it didn't have a whole lot of volume, but the open interest is big on all these. So this column is open interest. All right, let's keep moving. So that was kind of the rates thing I wanted to talk about. I guess the other thing I should mention is when I talk about a fuse being lit, what I'm really talking about is if this does spill over into high yield bonds, it's most certainly going to affect the equity markets, like, you know, your QQQs and things like that. They'll have the gas taken out of them. So I do expect a shock at some point soon. I don't know that it'll be anything other than a shakeout, but I think it's good to start to prepare for a shakeout right now, just based on what I'm seeing. And you know, it's from doing these kind of macro reviews. All right, did we look at KRE yet? I don't know. Let's look again. Let's look at KRE :XLF. So we can see this gives us a lot of important relative information. So these regional banking, they're smaller banks. And so when the smaller stuff is outperforming the larger stuff, it's a sign of health for that sector. So you can see that, you know, if you had been observing that the commercial banks were getting weaker and weaker and weaker going into 2020 against the big banks, you know, that was a sign that the sector was getting weak. And so when the big crash happened, it's because it was already vulnerable to it. But now we're in the opposite, where, you know, they're trending higher, and it's because the yield curve is really steep, for one thing. The other thing is things got priced, I think, for a really bad, like, closed economy. And as things start to open back up, earnings can go higher on a quarter-over-quarter basis. And so that's what the theory there is. XLP, consumer staples. That thing rebounded pretty good. I mean, this is really kind of a sleeper sector. But that's interesting at how strong that is since the lockdown crash. It hasn't been strong in 2021. So not too much to really dive into there right now. XLV, this is healthcare. I mean, this is just, what can I say about this sector other than this is like a stalwart sector. Probably loaded full of good names. The next up is XBI. This is a biotech. And similar thing here. It's just a stalwart sector. I think a lot of vaccine stuff and pandemic stocks maybe have given this some tailwind to run higher. I'm not really interested in diving into it right now, though. XLY. That's next. Consumer discretionary. I mean, this is. I think they don't have GameStop in here, do they? GameStop shares. I know that it was in one of these ETFs. Oh, it was in the retail ETF. Probably I should put. What's retail ETF? I forget. I'll find out what it is and I'll put it next to XLY on the list. But really interesting thing about the retail ETF is, let's see if we can find it. XRT, that's what it is. All right. Let me add that right here. XRT. Okay. So an interesting thing about the retail ETF is some of the funds who were short GameStop rated this thing and took the shares and converted them. I think what they did is they shorted all the other companies that were in this thing, or maybe just some select companies. Wow, Magnite. I didn't know that they were number one in there. That's interesting. And Blink. I've been in and out of these two. And GameStop. Wow. So this is really like a short squeeze ETF right now. There's a triple leverage version of this also. So let's look at XRT. Yeah, look at that. So some of the funds, I think they were taking possession of XRT shares and converting them, taking delivery of the shares so that they have shares at GameStop, and they were getting them cheaper that way. And maybe by shorting some of the other things in the basket. So that's kind of interesting. I don't know a ton about that. That was something I read like 3 weeks ago when this was going on. Yeah, that's really interesting. I didn't know that it also had Blink charging and Magnite in it. Like, why is Blink charging in there? Is that really a retail thing? I mean, I don't think of it like that, but it's an interesting list. So MGNI, I was in this one earlier. I got out of it at 60. I guess it was like 2 weeks ago, and it just hasn't really. It was around 60, and it hasn't gone really anywhere since. But I mean, I can't believe how well this is hanging on. It's just hugging this upper Bollinger Band and riding it higher, like with very high velocity. So one thing you can do too is, as long as it's above this 5-day moving average, you could just hang on to it. Maybe if you're trying to just trade this trend and get as much of it out of it as you can. And use that 5-day EMA as like a trailing stop when something's on a really strong run like this. It would have got you out here and maybe some other places on there. But, I mean, you could get back in when it makes a new high, or, there's various tricks like that. But this thing is so overbought right now. Like, the weekly RSI is just like pegged above 70. So I'm taking a rest on this one, but really strong stock. I didn't realize it was in XRT. So let's take a look at the triple leverage retail ETF. It's RETL. And so, I mean, this, in hindsight, I would have never guessed at this low that it would have squeezed this high up to at one point over 300. It's just incredible. So, I'm not a genius. If I was, I would have bought RETL at the bottom there. And believe me, I was looking at it. But I was thinking like, if we have like another tumble in the market, this would be a good thing to short. I wasn't thinking there were some of these ETFs that went out of business. So this one apparently somehow barely survived. But it's just breathtaking. Some of the kind of opportunity that's available in the markets. And this, without even like options or anything. Like, this is just like, it's a triple leverage ETF out there. Incredible. is breathtaking, really. I know that GameStop was a part of it, but I mean, there's a whole lot more going on in here than just GameStop. All right. We already talked about TLT, HYG, JNK, LQD. Let's look at TIP real quick. Whoa. So I'm not exactly sure what's driving that lower, actually. Because, I mean, I know the TLT is down. Something I like to look at is the ratio with TLT colon TIP. Yeah. All right, back over to TIP. I mean, it's been doing great for a long time. Like, I mean, look at this. 2018, it's been just running. And normally it's aligned with gold and silver and oil. It's kind of a proxy for that. But and I like to think of this as the U.S. military's version of the Swiss franc. So a lot of people don't know this, but the military, they have, I think, as one of the options in their retirement plans that you can get Treasury inflation protected securities. And so that's where a lot of military folks are invested. They're invested in TIPS. And that may be true for a lot of government workers, not just U.S. military. All right, so, I mean, this to me holds a little bit of mystery. Like, it would be fun to investigate this. So, first of all, let's stack it up against GLD. And it was underperforming for a long time. Now it's outperforming. Why is GLD performing so poorly? All right, so this like long run from here is about the same time frame that TIP was running up. TIP moves up like in a much narrower price range. But so GLD went up like 80% or something from this low in 2018 at 111 up to in July of 2020 194. So something I'll call out is a lot of things peaked in around June and July of 2020 on the reopening. Like, why GLD is so weak? It could be that GLD is now so much easier to manipulate than like gold is now easier to manipulate than silver. That may be a factor. I don't know if that's true or not. Like, it could be that silver really is getting squeezed and it's no longer easy to look at. So this is the gold to silver ratio, and I mean that's really low. It's 65. Let me zoom out on this. This is really, really low, and I can't believe it broke out over 100 right here. I actually panicked out of silver miners when it broke 100, and I mean I maybe was positioned a little bit too big in them, and that's what made me do that, because I was adding all the way up to 100. And then when it broke above 100, like right there, I got out like right away. And, you know, it's instead of going back into this, I went back into other things and made a lot of money there. But, I mean, great opportunity. This was just like almost a once-in-a-lifetime opportunity to buy miners at that gold to silver ratio. So when this is declining, it's good for metals. I mean, generally, but it can mean a lot of things. So that's why I suggested, like, hey, even though gold isn't running up right now, this ratio is dropping. So does that mean that there really is a squeeze on silver right now? And I'm thinking that they may be trying to do their manipulations with gold because they're out of room with silver. And if that's true, then we can expect this ratio to fall a lot lower and for miners to start to run. And maybe eventually these metals prices run too. But at the end of the day, like, if we look at FCX, I was talking about this earlier. Let's look at FCX. Let's look at a weekly. So look at this from the low. Just under $5, and now it's $37. Huge move. But what about let's look at just GDX, right? The gold miners ETF. You see how much Freeport-McMoRan is outrunning gold miners? I mean, this is like mysterious to me. It's could it be that Bitcoin and cryptocurrencies are taking enough of a share away from the precious metals, the role traditionally played by precious metals, at least for now, that's why gold miners aren't keeping up with Freeport-McMoRan, which is like copper mining and stuff. So here, let's look at Freeport-McMoRan on here, FCX. We're going to look at profile. Freeport-McMoRan engages in the mining of mineral properties in North America, South America, and Indonesia. The company primarily explores for copper, gold, molybdenum, silver, and other metals, as well as oil and gas. This is a miner, but primarily copper. I think one of the drivers for Freeport right now is probably there's a lot of home building going on. And the home builders ETF is ITB. And yeah, I mean, look at that. It's super strong. It's not as strong as Freeport, but there's probably some stocks in here that are as strong as Freeport. Let's look at the holdings of Freeport. I'm sorry, of ITB, the home builders ETF. I know it has like Home Depot and Lowe's. And then it's got Lennar. Yeah, so there's Lowe's, there's Home Depot, Toll Brothers, DR Horton, Pulte Group. So yeah, this is a really interesting one. Real estate's probably pretty good right now. It's tough to buy a home in some areas. And so I think that's probably going to be a driver for more home building going on. And people are doing additions on their homes because the home has to be the classroom. It has to be the work office. People's homes now have to fill a lot more roles than they used to. And so I think that's, a lot of people are looking to expand their square footage or move into bigger homes, upsizing, moving out further away from the city. And so while commercial mortgages may have not done so well, certain areas of real estate have done well since the lockdown crash. All right, let's keep moving. XLB. Oh, wait, no. Did I skip over some here? I think I did. Let me add in ITV on this list. Okay, XRT, that's the retail. Did I add that in the wrong spot? I think I did. ITV, okay. XLB, did I look at that yesterday? Material sector, yeah, super strong. But I mean, this is a trend that's been in motion. This is a train that's already got this is a momentum, right? The train's already in motion. Generally, I'm looking for new emerging trends, which is why I'm talking about, I've got to focus on like Jets right now and MJ and some other things. I mean, MJ's been running for a while, but I think that theme has legs. All right, so let's skip down now to, let's go to REM. This is the mortgage REIT ETF. And, I mean, it's had a hell of a rebound, but, I mean, the collapse that this thing experienced was like nothing I had ever seen for mortgages. I would have never thought that, other than like a full-blown inflationary collapse. I wouldn't have thought like a COVID lockdown. I mean, this COVID lockdown is such a joke that it's just like, I mean, I feel like nobody even really cares, like in the grocery store anymore about it. Like, I just came from the grocery store where I was getting this beer, this Mind Haze IPA, which is delicious, from Firestone Walker. Great brewery. I like their beers a lot. Anyway, it's just like nobody cared. They're in the store like wearing the mask because it says on a sign out front that you have to wear a mask if you're going to be in there if you're over 5 years old. But people were just like, they didn't care if you got near them or anything like that. It just generally seemed pretty cool. I mean, there's still a few people that are nuts about this stuff, but all right. Anyway, I'm not in REM right now. In fact, I don't even have plans to go into it because this is a space where I think that the yield curve widening can help it, and that's really what's driving it higher right now. But I don't like the prospects for commercial mortgages, and commercial mortgages they're not the whole thing here. There's a whole bunch of different types of mortgages in here, including agency mortgages and residential mortgages and things like that. But I don't know. I'm just not super excited about REM right now. Maybe I should be. IYR. So I think, this is a real estate ETF. This has a little bit of an overlap with REM. Some of the same companies, I think. Let's go take a look. At least there used to be. Their largest holding is a cell phone tower real estate property. Okay, so I'm not seeing AGNC and NLE Capital Management. I think maybe they've taken those out of this, or they're just smaller allocations. I think they used to be like big holdings in this. So this used to have mortgages, but maybe they've refined it. It does have Public Storage, which is a storage company. That's really interesting. Another big storage company is Extra Space. Let's look at both of those actually. My phone is ringing. All right. I probably need to wrap this up soon. So yeah, look at EXR. I mean, this is like a pretty good stalwart stock. It's slow paced, but if you're an investor with a long view, it's good. All right, hang on one second. It has outpaced PSA. All right. Yeah, it's outpaced PSA lately. I don't know if they're taking market share from them or whatever. But if we look at EXR : PSA, you see this ratio chart. Like EXR has been the better investment for some years now. Please excuse me one moment. All right. Done with that. Okay. Yeah, we're getting close to the bottom of this list. XLRE. So real estate select sector. I'm not sure what's select about it. This was kind of a new one for me. I came across this on the FinViz screener. We can take a look. XLRE. It looks like the exact same holdings as IYR. IYR : XLRE. Yeah, it's like the same thing. So probably I'll take the less liquid one off. So one's a spider fund, the other one's an iShares. Okay. I'll worry about that later. All right. VNQ. Okay, this is the Vanguard Real Estate. Let's see how their holdings stack up. Holdings. They've got one of their own index funds as the number one holding, and the rest of the holdings look pretty similar to the other ones. So there could be some interesting pair trades in here, like going long American Tower and going short Simon Property. It's like I'm long cell towers and I'm short malls. Let's look at that ratio chart. AMT colon SPG. AMT colon SPG. Yeah, well, it was a great trade until and then it ran out of gas last year. Okay, interesting. It actually was working for a really long time too, before before it started to fall apart in the fall. This October time frame, this was kind of like a secondary reopening rally happened in some areas. So this is what can happen to you if you like take these long short trades. Like they can really blow up on you, as this one is doing. All right, what's next? I need to check my messages. Sorry, hang on one second. All right, well, I got to wrap this up soon. We're getting close to the hour, and it's been a fun happy hour. I really enjoy doing these. Any other things I want to get to? There's a bunch of international stocks here. Let's look at one. Let's look at FXI. And I think I highlighted this one yesterday too. When I look at this on a monthly chart, that to me says, hey, time to pay attention to Chinese stocks. I actually pruned all the Chinese stocks out of my holdings. I don't hold them anymore. I'm not really excited about investing in Chinese companies, but they could be great for trades. You know, you could get some good swing trades in there. After the Luckin Coffee and some other things like that, let's just say that I have some extra cautions that I take with Chinese companies. Anyway, look, it's been fun. So thanks for hanging out, and hopefully you enjoyed this time. And do me a favor, if it was fun, hit the like button. This is a brand new show, so I'm trying to get the word out. If it's helpful for you, share it with your friends on Twitter, whatever. Try and help me get the word out, please. All right, thanks so much. Good night.